G'day, Binancians, and welcome back to this week's Binance Beach. We have tax season in full swing, and last week we hosted a huge tax Ask Me Anything session with a bunch of local crypto tax experts. But we had so many questions from the session that we wanted to jump back on and ask another crypto tax expert the rest of your user questions so we get through them and answer everything that you guys wanted to know. Matty, mate, welcome back to the show. Tax season's in full swing. How are you finding it?
Yeah, it's actually not too bad. This is a pretty relaxed time of year for me. So, got to take a post hectic tax season break. It's usually the extension deadline in May that most of our Aussie clients are battling for. So once we got through that, now things have really calmed down.
Yeah, I guess maybe people are keener to jump in and do the tax returns quickly if they think they've got losses to harvest. But maybe last year was a better year for a few traders, so they're thinking, let's push those tax liabilities out for a little while.
Yeah, I would say that's probably the case.
Oh, cool. All right, let's get into it. Smash out some rapid fire. Actually, before we do you have any thoughts on the market at the moment? We hit another all-time high for Bitcoin overnight, which is pretty wild, but we're still a fair way from all-time highs on ETH and most other kind of tokens in the ecosystem. Any quick market thoughts for our users before you give some tax wisdom?
Yeah, I'm just curious watching things play out at the moment. It's the past market cycles don't seem like you can use that as an analogy for this market cycle. I think everybody's kind of grasping for, like it's so different than the past. How are we going to have a reference point to base our predictions off of? And for me, I'm lucky to be a little bit more of a hodler and sit back and watch kind of guy. So yeah, I wouldn't have any good advice for any of the swing traders out there, but I'm just sitting back and really enjoying the show.
100%. I was chatting with someone this morning about Bitcoin dominance, which, continues to grind up and to the right. And I was checking the poly market for whether Bitcoin dominance will hit 70% or 60% first or next. And they are saying 40%, 70%, 60% for 60%, which is kind of funny. So the smart money, if you call it that, is betting that we are going to see a bit more of an alt surge soon. But I think what I said and what I thought was interesting is it would be fascinating to look at including the market cap of like Bitcoin treasury companies in that Bitcoin dominance now, because in a lot of ways, like they are a new alt season. They're a new season of, obviously they're not altcoins, but alt crypto exposure. And so, yeah, I think that's fascinating. And then you zoom right out and you think about that Sailor chart where Bitcoin's a 2 trillion in the top little left corner, and you've got all of the other assets, stocks, bonds, equities, real estate. And maybe that's the Bitcoin dominance that we should be watching. And that keeps grinding up too. But it's well below 60 to 70%. That's for sure. Let's kick into some tax questions. Kick it off. Thanks again to our users for submitting all of these. First up, Maddie, will Bitcoin and Solana be tax-free in Australia next year?
They will not be tax-free, according to our friend Harry Dell. I'd say go back and watch that Binance Beach episode, and that should give you everything that you need to know why I'm saying no, they won't be tax-free.
Yeah, I'd be surprised if the ATO gives up that revenue. Number two, how can I strategically plan my crypto transactions throughout the year to optimize for tax efficiency while making sure that I'm compliant with evolving tax regulations? And this user is particularly interested in DeFi, staking, and cross-border transactions.
Yeah, so the most important thing is that you get a crypto tax software set up so that you can capture your on-chain data and properly categorize it and make sure that your balances reconcile. That's going to make sure that you have a really good idea about the cost basis of your tokens, as well as like the holding time on any of the inventory that you have. That way you can make informed decisions about, do some of my positions qualify for long-term capital gains discounts? If so, making sure that like you perhaps sell those lots first if you just need some fiat. The other thing is like it's a little bit difficult to optimize as you go. It's often better to have a strategic plan for your taxes in place and get everything set up at the beginning. So taking a look at your own transaction kind of strategy, whether or not you're more of a high frequency trader, more of a hodler, whether you're a DeFi user that earns a lot of, let's say, on-chain income, that might dictate which crypto you might want to personally custody versus which you might want to custody within some type of entity structure that will kind of limit your tax and allow you to compound any gains a little bit further. So yeah, pound of, what do they say? Ounce of prevention is a pound of cure.
Yeah, man, I think the best alpha there is having your tax software, crypto tax software set up before the end of financial year, and just getting the data and knowing where you stand on those potential obligations and understanding which could be potential losses to harvest and which could be, gains that you could balance or profits you could balance with losses. Like just getting the data and being aware ahead of time when you can make changes, I think is the best piece of advice you guys give. Which is a better and more popular way for tax optimizing intraday trading or swing trading? Is it to trade as a sole trader or to set up a company and pay a fixed 25% tax rate? And then there's kind of second part to this question here about reinvesting the profits for compounding your gains faster. I'll take that second part first of all, because it's definitely something that we covered in the last step, and we see a lot is people getting caught out, kind of reinvesting their taxable or the tax obligations and trying to double down on gains, and then ending up doubling down on losses. So that is something to be really aware of and concerned about, and across before you're just going big, particularly if you are trading on the higher end of the risk spectrum. But what about tax structures for day trading or swing trading? What do you see as the most effective method for your clients, Matty?
Yeah, it completely depends on whether or not, because as the user mentioned, you would be capping your tax rate at 25% if it's an operating company, but it would actually be higher if you're just using it for trading. Now, the thing is, you have to realize that with any entity structure, like if you're doing like a trust setup that has a company as a trustee and you have a company that you are trading inside of, now you have 3 different entities that require their own ATO reporting, and you're going to need to pay an accountant to actually report on behalf of each of those entities every year. That has a cost. For company registration, you're going to have to pay your ASIC annual fee. That has a cost. Like there are administrative costs to operating within an entity structure. And so you need to do a little bit of a cost benefit analysis and determine, is the potential gains that I might have from my trading, is it going to be beneficial to potentially cap my tax rate at, let's say, 25 to 30%, for somebody who's a high income earner or somebody who's expecting to have 200,000 plus of gains within a year? Then it might make sense for you to set up that company structure so that you do cap the tax rate and you're able to then compound the leftover amount after tax at a higher rate over time, assuming that you don't need to actually withdraw any to fund your lifestyle. Whereas if you're just playing around with trading and your stack is like $10,000, chances are that if you go, you might have a lower tax rate in the company, but then those administrative costs of actually managing the entity setup is what's going to absolutely kill you. So you really need to take a look at your own personal situation and just talk to your tax advisor, your primary tax advisor, about what they would suggest, because it is a bit individualized.
Yeah, and when you get into that level of detail, I think you probably need some personalized advice, right? Like you can get an idea from listening to great breakdowns like the one you just gave, but definitely talk to someone about your specific situation, get some personalized advice from a professional. Do you have to declare crypto when it's held at a loss?
So if you didn't have any taxable events, like you just purchased crypto and then you held it and it's at a loss, then there's actually no CGT events that are associated with that. So there's not really anything to report. But if they're talking about, I have made a loss by actively trading crypto, or you have other taxable events on chain, then you would need to report those CGT events on your tax. And you would be best suited to do it because you can actually carry forward your losses in Australia. So if you have actively traded and lost $10,000 this year, if you are putting that onto your tax return, then you can carry that $10,000 loss forward. And if you make a gain next year, then you essentially get to keep that first 10,000 of gains tax free. And then you essentially get taxed on the incremental gains from there.
That leads into the next question quite nicely. Can I offset capital losses from NFTs or altcoins against gains from Bitcoin or Ethereum in the same financial year? So can I use the losses from one asset to offset against gains from a different asset?
Yeah, as long as it's a CGT asset, then absolutely. The tax softwares will calculate that for you. So they essentially keep a running ledger of what are your gains and losses on each position. And then they're going to give you a net number that you can use to report.
If I spend crypto on buying things like a car, do I have to declare that as a taxable event?
Yeah, buying a car kind of is going to put you outside of that personal use exemption based off how big it is. So you are essentially disposing of a capital asset to purchase another piece of property. So most likely the ATO is probably going to look at that and say, you have this capital asset, you've disposed of it. They're going to look at what was the cost basis of it, what was the value when you sold it, and then or disposed of it to get the car, and then most likely they're going to expect you to be reporting that.
It's a bit of a segue, but for me, I think one of the real barriers at the moment to mainstream Bitcoin or stablecoin adoption, stablecoins less so, but definitely Bitcoin, is the tax treatment that it still has, right? It's very hard to compete on the currency and medium of exchange level when every transaction is a taxable event. Every buy, every sell, is a taxable event. What's your thoughts on the idea that taxable treatment of Bitcoin is a barrier to adoption, or do you think that it's not so big a factor in Bitcoin and crypto adoption?
It's a good question. I don't really think of Bitcoin as being a good medium of exchange. It's pretty expensive to exchange it for the user. Whereas it's so much more seamless to be able to do that with, even stable coins. Like, you look at some of the companies that have debit cards that you can spend your stable coins. The fee to the user is essentially not there because, the credit card processing fees is, or the card processing fees is kind of how that revenue is generated. So I don't personally see Bitcoin as being a great medium of exchange. And I don't think that it would hinder its adoption really, because it's such a slow blockchain as well. Like, imagine waiting 20 minutes for the transaction to confirm before the bartender is going to release your beer.
Yeah, that's true for base, for the layer one, but then you've got layer twos like Lightning or something, like they solve the settlement time problem. And that would be the method of adoption, right, for general use of Bitcoin as a medium of exchange.
Yeah, you see in the U.S. there's like Senator Loomis tried to get the de minimis exception added to the big beautiful bill, which essentially, for those listening, that's originally the draft that I saw was going to be any crypto transaction under $600 where you are making a purchase. That would be essentially like similar to the personal use exemption here, up to a certain limit of spending per year. I know that they are looking at reintroducing a bill that I think has a $300 de minimis exception. And I believe what they're trying to do there is to just make it easier for crypto to be used as a medium of exchange and increase its adoption in other ways. So I think that there are ways from a, let's say, like policy perspective, that could be improved.
Yeah, but whether there's that much incentive at a government level to really go ahead and do that and leave off of potential tax revenue when you look at the revenue problem that the US has, that Australia has, at a nation state level, we need revenue. So yeah, it might be a tough uphill battle for Lummis. If I stake BNB on the DeFi platform and earn rewards in a different token, for example, Cake, how does the ATO treat this? Is this income or is it a capital gain?
Yeah, so I would refer them to the ATO's DeFi guidance that they put out. Now, obviously, we've got Harry Dell who says that it's as good as being toilet paper. It's not actually binding law or anything like that, but most of your tax agents are going to tread very lightly, and they're most likely going to want to follow the guidance that the ATO has released. The guidance that the ATO has put out on their website says that for DeFi transactions, like, for example, providing liquidity, depositing collateral, or staking, where the asset that you deposit is being sent to a smart contract that has a balance of other of the same asset, and you no longer control it, they actually see that withdrawal to the smart contract as a CGT event. And then they see you receiving it back as another one. So the strange way you'd have to treat that if you don't get a receipt token, let's say you have Coinly or Crypto Tax Calculator set up. If you don't get a position token, essentially you need to track that position separately, which is super annoying. Like, you can also set up like a placeholder token for it. But the idea is, let's say that you put $100 worth of BNB into that staking contract. You purchased it for $80. You have a $20 capital gain when you actually put it into that staking contract. And then if you take it out and it's worth $120 now, the position was worth 100 because that was the value when you entered it. And then now when you take it out, it's worth 120. So the difference being another $20 gain. So the ATO's DeFi guidance would indicate that you have CGT events on the way in and out of that staking pool with your BNB. And then when it comes to actually receiving the rewards in the Cake token, they would, based off their guidance on their website, be saying that that is considered income at the fair market value when you do actually receive that token. So, whether it's when you, claim manually or when you unstake the BNB and it auto claims, they'd see that as being an income taxable event.
Simple as. Here's another DeFi one. Say you're using a DeFi protocol, and this is a question about, I guess, smart contract automation. What happens if you have let's say you're moving liquidity and you're using some kind of bridge like a Stargate or a Squid or some kind of tool that's going to allow you to move assets across chain, and potentially we're seeing also like cross-chain swaps as well, so where you might have USDT on Arbitrum and then you execute a cross-chain swap and you end up with WIF on Solana, right? You're moving both chains and tokens. In a scenario there where there's potentially multiple transactions happening, is each step going to trigger a different CGT event, or is this treated as a composite transaction, like a single transaction? It's a bit of a complex question, but does that make sense?
Yeah, it does make sense. So yeah, I would say that the example would be, like you said, let's say that you've got USDT on Arbitrum and you use like a cross-chain swapping protocol or app, and it goes USDT, you want to get it to WIF on Solana, and it goes from USDT, maybe it has to become USDC on Arbitrum to then get bridged as USDC to Solana, and then it has to do a swap from USDC on Solana to WIF and then hits your wallet. So from my perspective, it would be a really unnecessary burden on the taxpayer to actually have to document each step of that transaction that occurs in a smart contract outside of their wallet. The easiest way to do that, and it's going to have absolutely negligible difference in terms of tax impact because of how quickly the transaction settles. It's just going to be, okay, you've got USDT going out. What was the cost basis? What's the value at the time that you essentially cross-chain swapped it? You'll have a CGT event there. It'll be negligible because it's a stable coin. It's just going to be foreign exchange rate fluctuation. And then you're going to have the WIF that you receive on the other end. And then that is going to have the cost basis of the value when you receive it. So it looks like a composite exchange. So the best way to do that, let's say with Coinly, is to just merge the transactions as a trade. The best way to do that with like crypto tax calculator is you need to go and label them as a buy and a sell and make sure that the values match if you're using any of those partner platforms.
Makes sense. Again, nice and simple. Oh man, you really go down the rabbit hole when you start using DeFi from a tax perspective. It gets very complicated very quickly, and without CTC or without a crypto tax software, you really are pretty stuffed, I think. Final question. I think I asked the other guys this too. Why can't the ATO just ask how much fiat we put in and how much fiat we took out? Give us 2 numbers on our tax return. Why do they need every single transaction?
Yeah, it's a great question. I think it's just because they're going to be asking, shares traders to declare each trade that they make. So I think it'll be something where if they just made that the way that crypto tax reporting was, then you're going to have share traders and other people who are trading CGT assets kind of in an uproar. Why do these guys get different treatment? And I honestly think that that's a really nice way of doing things. Like, for example, the way that Portugal handles crypto tax is just like, all right, what was the gain when you convert it into fiat overall? And if you held it, if you held a crypto asset for more than 12 months, then they actually don't tax you, which I think, Australia and the ATO probably wouldn't be able to do because you're going to lose out on a lot of revenue that way. But yeah, it does suck. Most people tend to transact a lot more in crypto than they ever have in any other asset class. So now all of a sudden you have all these individual taxpayers who have probably as many transactions as a hedge fund might have in normal operations. And this individual has to figure out, that hedge fund that has like an entire finance and accounting department, they get it done. But how the heck am I supposed to do this in a cost-effective and time-efficient way for me?
Yeah, 100%. Yeah, you're absolutely right on the frequency of trading. Like, even day traders with stocks could rack up, in a year, a day's worth of transactions when you're just mucking around on DeFi. It's pretty wild, the transaction frequency and how quickly your obligations can stack up. But that's why we need great software. And of course, we have 30% off discount codes for Coinly, for Crypto Tax Calculator, and for Sila for our Binance users. So I'll drop the link to those back in the show notes. Thanks so much for jumping on, Maddie. Do you want to share really quickly before we wrap up how you help Aussies with their crypto tax returns?
Yeah, so we don't file your tax returns. We don't act as your tax agent. We provide a very specialized service where you set up your crypto tax software. You realize that, it's going to take you hours and hours and hours to figure out how to use it yourself. So then you use a service like ours where we have chartered accountants and bookkeepers and data analysts who go in, look at all of your transactions, do some on-chain investigation, or reconcile the exchange data, make sure that everything's properly categorized, make sure that the balances reconcile, and then from there you can feel a lot more confident in the accuracy of the crypto tax reports that come out of that software. So that's the TLDR of it. There's a little bit more benefits that we have, but that's how the service works.
And a good service it is too. Thank you so much, mate, for joining us again. And thank you to all you Binancians for jumping on and for asking your tax questions. The next couple of weeks, we've got some pretty exciting announcements to make. We've got, a couple of big ones we'll make on the show. So tune in. And of course, as always, please make sure you like, subscribe, and tell us who you'd love to have on the show and what you'd like us to talk about as well. We'll do our best to answer your questions and help out our users wherever we can. Have a great weekend, Matty. Enjoy, mate. I hope you get another wave.
Yeah, likewise. Hopefully it's not 15 knots onshore for you.
Yeah, fingers crossed. Have a good weekend, Binancians. We'll catch you next week. Bye.
Yeah.
Please note that this discussion includes insights from non-affiliated third parties and key opinion leaders. Binance provides this platform for informational and educational purposes only and is not responsible for any content or insights provided. This information should not be considered as financial, tax, or investment advice from Binance.